Every empire dies the same way. Eventually, the interest bill gets bigger than the empire itself. Not because of one bad election, not because of one war, but because of a simple debt equation that never, ever loses. Most people think politics decides our future, but the brutal truth is this. Once the numbers cross a certain line, no leader can save the system. I'm going to show you the exact pattern that turned past superpowers into failed states, and then we'll overlay today's numbers on that same curve so you can see exactly where we are right now. Look, empires don't just randomly fall out of the sky, they follow a pattern. First comes expansion. War, welfare, grand projects, bread and circuses. Debt rises, but nobody cares, because times are good and growth looks strong. Then the bill shows up. Here's what actually happens. The state borrows heavily to fund wars, to buy social peace, to paper over every crisis instead of fixing anything. At first, the interest bill is small. It's an annoyance, not a threat. You can grow your way past it, but over time the debt stock piles up. Rates tick higher. The interest line on the chart bends upward. And one day, without any big announcement, the system crosses into what I call the debt trap, the point where interest is growing faster than the economy and faster than tax revenue. That's the key. Once interest grows faster than what you can realistically tax or grow, you're done. The math is the math. Take France before the Revolution. The monarchy had financed wars, court luxury, and a sprawling bureaucracy with borrowed money. Year after year, more bonds, more promises. Eventually, interest payments consumed such a large share of royal income that there was almost nothing left for anything else. They tried to raise taxes, but the population was already squeezed. Any serious attempt to tax the privileged classes risked revolt. So the state sat stuck between angry creditors on one side and an angry population on the other, with no room left to maneuver. That's the debt trap. You see the same thing in Weimar Germany after World War I. Crushing reparations and domestic debts met a shattered economy. Instead of defaulting outright, the government turned to the printing press to service obligations. For a while, it looked like a clever workaround. Then the currency imploded, savings were destroyed, and the middle class was wiped out. Different countries, different eras, same pattern. So here's a simple mental model. Phase 1, manageable debt. Interest is low, growth is decent, and the debt-to-GDP ratio is stable or rising slowly. Governments feel invincible. Phase 2, fragile debt. The ratio is high. Interest costs are starting to bite, but policymakers still pretend a bit more growth, a bit more reform will fix it. This is where excuses multiply. Phase 3, the inescapable debt trap. Interest becomes one of the largest line items in the budget. Servicing old promises eats the future. At that point, cuts big enough to matter are politically impossible, and growth fast enough to matter is mathematically unrealistic. I call the center of this phase the kill zone, the zone where interest costs swallow such a dangerous share of state revenue that the system can't fund both its past promises and its present obligations without either defaulting or destroying the currency. That's how empires actually die. Not with one speech, but with a long slide into the kill zone. Now look at where we are today on that exact same curve. The modern debt cage. When interest eats the future. Now look at the modern numbers. In the United States, federal debt is already around the size of the entire economy and is projected to move toward 120% of GDP over the next decade. That's not a theory, that's the official trajectory. Interest costs have already blown out, around $1 trillion a year just to service existing debt. Under current projections, those interest payments keep climbing. By the 2003s, they're set to take more than a fifth of every federal revenue dollar. Remember that phrase, more than a fifth of every dollar, just to stand still. Here's why that matters. When you lay out the federal budget in plain language, 4 items already dominate: Social Security, Medicare, defense, and interest. Those 4 categories together essentially consume the bulk of tax revenue as is. Everything else you think of as government, infrastructure, education, research, basic administration is squeezed into what's left. And as rates stay elevated and debt keeps rising, interest climbs the ranks. It doesn't negotiate. It doesn't run for office. It just shows up. People like to say, we'll grow out of it. That's the comforting story. But stack the math side by side. If your debt stock is growing faster than your economy, and the average interest rate on that debt is higher than your long-term growth rate, you're not growing out of anything. You're compounding the trap. That's where we are. Zoom out to the global level. Public debt worldwide is about $111 trillion, with global deficits hovering around 5% of GDP. That means the world as a whole borrows about 5 cents for every dollar it produces, every single year, just to keep the current system limping along. And remember, these debts are now being refinanced at higher rates than the last decade, so the interest curve is bending up everywhere at once. Look at France right now as a modern parallel. Its public debt is already above 110% of GDP and climbing. Servicing that debt is eating a rising share of the budget. Interest has doubled in just a few years and is projected to keep rising, crowding out other spending. Official European rules say debt should be around 60% of GDP and deficits capped near 3%. Those rules are on paper. In reality, they're ignored because enforcing them would require cuts that would put millions of people into the streets. Again, same pattern. High welfare costs, aging population, persistent deficits, rising interest, political paralysis. This is why I keep saying this isn't partisan, it's structural. In the US, debt climbed under Trump. It climbed under Biden. It climbed under Obama and Bush. It will climb under whoever comes next because nobody can touch the real drivers without committing political suicide. So, what is the modern debt cage, in simple terms? Think of a household that keeps refinancing its mortgage every few years. At first, rates are low, payments are manageable. Then rates rise, and each refinance means a bigger payment on a bigger balance, while income doesn't grow fast enough to keep up. Eventually, the mortgage, interest, and basic fixed bills eat so much of the paycheck that there's nothing left for maintenance, savings, or emergencies. That's the cage. At the sovereign level, when interest becomes one of the largest line items in the budget, your policy options start closing one by one. You can't cut big entitlements without social unrest. You can't slash defense without strategic risk. You can't raise taxes much more without hammering growth and provoking backlash. So you drift, you kick the can, you refinance at higher rates, you layer on more promises, and all the while the interest share creeps higher, the kill zone approaches, and the room for painless choices disappears. We're already beyond the point past empires reached before their crises hit. Higher debt to GDP, larger interest burdens, more rigid political systems, more aging populations, more entrenched expectations. That's the modern debt cage, a system where servicing yesterday's promises devours tomorrow's possibilities, and where the math quietly overrules the speeches. So once you're locked in the cage, what actually happens next? History says there are only two exits. Exit one is explicit default. You simply stop paying in full or at all. You tell bondholders, we can't honor these promises. You restructure, you extend maturities, you pay 50 cents on the dollar. It's brutal, it's honest, and it instantly exposes the insolvency. Very few major powers choose this path on their core debts because it's politically radioactive. It means admitting failure in plain language. It shatters domestic confidence and foreign trust overnight. It raises borrowing costs for a generation. So they reach for exit two, destroy the currency. This is the path of implicit default. You keep paying the nominal amount, but you trash the value of what you're paying with. The numbers on the bond say you got 100, but those 100 units buy a fraction of what they used to. Weimar Germany did this in the early 1920s. Faced with crushing reparations and internal obligations, the government printed to cover the gap. For a while, it felt like a workaround. Wages went up in marks, debts were serviced in marks, and politicians could claim they were honoring commitments. Then the mark collapsed. Savings vanished. Contracts became meaningless. Social order cracked. Zimbabwe followed the same script. Venezuela more recently. Different triggers, same mechanism, debts too large to service honestly. So the printing press did the dirty work until the currency itself failed. Why does the political class always prefer inflation to open default? Because inflation is easier to disguise. They can blame greedy corporations, supply shocks, speculators, anything but themselves. They can claim they're protecting growth, protecting jobs, protecting stability, even as they quietly transfer wealth from savers, wage earners, and retirees to debtors in the state. Look at our world now. Persistent deficits that require someone to keep buying the bonds. Central banks stepping in whenever markets balk. Quantitative easing is the polite label for creating new money to absorb government debt. The likely sequence is straightforward. Yields spike as investors demand compensation for risk. That raises interest costs, which worsens deficits. To contain yields, central banks buy more debt with newly created money. That supports markets for a while, but it pushes inflation higher. At some point, trust in the currency erodes. Then you get either a sharp reset or a slow grind towards something new. I can't give you the exact day this plays out. Nobody can. But the direction is not optional. The math forces one of these exits. So if the system is locked into this path, what can you actually control? You control your exposure. First, reduce your dependence on fiat promises that only work in a stable currency regime. That means don't leave your entire future in unfunded pensions, long-term government IOUs, or idle cash balances that can be inflated away. Use them tactically, not as your only lifeline. Second, tilt your life toward hard or productive assets and away from pure paper claims. That can mean real businesses, useful real estate in resilient locations, selective exposure to scarce commodities, or skills that generate income regardless of which logo is on the money. Third, build multiple income streams and real networks. In every crisis, the people who do best are those who aren't tied to one employer, one client, or one system. Redundancy is survival. And stay data-focused, not narrative-focused. Watch debt levels, interest costs, inflation trends, and policy responses. Ignore speeches, slogans, and campaign ads. They're background noise. Now ask yourself one hard question. When your government has to choose between admitting default to voters and quietly inflating the debt away, which button do you think they'll press? Tell me how you're thinking about this debt trap in the comments. If you found this useful, like the video and subscribe so you don't miss the next breakdown as this crisis unfolds.